Welcome, everyone, and thank you for joining us for Improve Your ACA Compliance to Avoid IRS Financial Penalties, sponsored by First Capital Consulting and presented by Joanna Kim Brunetti and Greg Casabucci. Before we begin, I'd like to remind you that this webcast has been pre-approved for HRCI and SHRM credit. Please be sure to attend the complete webcast in order to receive your credits. If you have any questions today for our presenters or for HR.com, please type them into the questions tab on your GoToWebinar control panel, and we'll be sure to follow up with you. And it's my pleasure now to turn you over to today's presenters.
Thank you, Sylvia, and welcome everybody. My name is Gary Davis. I'm the Vice President of Marketing and Communications for First Capital. For those of you who aren't familiar with us, we are a company that started in 1999. We're a regulatory technology company, and we focus on workforce data. We offer services for optimizing risk management and regulatory compliance, including compliance with the Affordable Care Act. We also work in workforce management and financial performance, as well as data quality, and our regulatory services, as I mentioned, include ACA compliance and pay equity, auditing and analytics. Today, we are here to talk about the ACA, and here to present is Joanna Kim Brunetti. Joanna is our VP of Regulatory Affairs and General Counsel. She has extensive legal experience working in a wide range of regulatory, employment, tax, intellectual property, and other related business issues, and has been spending a lot of time focused on ACA compliance. Also with us today is Greg Casabucci. Greg is our Vice President of Business Development. He's been recognized as an expert in the deep complexities of the ACA and works regularly to help employers navigate the healthcare law to minimize the risk of exposure to financial penalties, and has been working a lot with employers these days on how to respond effectively to the IRS Letter 226J penalty notices to help employers avoid significant penalties. So with that, I'm going to start today with Greg to give us an update on the latest IRS ACA enforcement activities.
Sure, thank you, Gary. So what we're noticing is around November of 2017, the IRS started sending out proposed penalty letters under the Letter 226J. We know that they've identified just under about 50,000 applicable large employers for a total of $4.4 billion in proposed penalties associated with the 2015 tax filings alone. This is based on about just over 318,000 1094-C forms that the IRS received in 2015. So that accounts for about 15% of the market filed 1094-C forms that would lead to a 226J penalty letter. We don't know how many have been sent out, but we assume that the IRS is very close to finalizing the 2015 tax year and moving on to 2016. Assessments can be in the several millions to a few $100s, depending on if they're assessing the A penalty or the B penalty or both on a month-by-month basis. We also know the IRS is using substantial technology systems to automatically identify non-compliant employers who the Letter 226J should go out to. 2015 was the first reporting year, so the IRS did offer several transition reliefs, one of which is the monthly accuracy only needed to be 70% on a month-by-month basis in order to avoid the A penalty. But that number does change to 2016 and forward tax years, so we expect to see a lot more enforcement as the IRS moves into 2016 and forward tax years.
So Greg, you mentioned that we're still receiving Letter 226J notices for 2015. I know that we're aware of some that were just issued this month, and some of the millions of dollars. Can you give some kind of feel for some of the more interesting penalty notices that you're familiar with, and why they ended up being in the millions of dollars?
Sure. I mean, the way it works is you have an employee that obtains a premium tax credit, and the IRS is going to use their technology system, the Affordable Care Act Compliance Validation System, to cross-check and look for a 1095-C form by an employer. And when that form is noticed based on the Social Security number, they're cross-checking on a month-by-month basis the premium tax credits. And so what we're seeing is that a lot of the 1095s that are being filed by employers are very inaccurate due to a number of reasons that I believe Joanna will go into further. But essentially, that is triggering a red flag and putting the burden of proof on the employer. So the IRS is going to automatically assess a or B penalty once they catch that, and then they're going to put the burden of proof on the employer. Now the employer is going to have to go through the painstaking process of essentially redoing the entire Affordable Care Act and making a proper response back to the IRS within the 30-day time frame that the IRS allows.
So, and Greg, one of the things that you mentioned earlier was that we know now that the IRS has the data to start issuing Letter 226J notices for 2016. We haven't seen any of those yet. They still have a number of letters, as you mentioned, to send out for 2015 compliance. But can you talk a little bit about how that process for 2016 may be a little bit different than the process the IRS has used in sending out 2015 letters?
Yeah, so the IRS, it appears that they're allowing the 1411 certification process is being done through the 226J. So as an employee gets a premium tax credit, they're cross-checking that 1095 and allowing the employer to make the correction at that level. So we see a lot of employers, because this seems to reside in a lot of technology platforms, the default settings in these systems seem to go against the employer and trigger these type of penalty notices. So what we're finding is employers are failing on a number of parts to properly prepare accurate 1094-95 forms, thus leading the IRS to use their technology system to automatically identify. As we move into 2016, that margin of error went from 30%. You only had to do 70% accuracy. It went down to 5% margin of error. So you have to have month-by-month accuracy of 95%, and it's a pass-fail. So the IRS is going to simply take their system when anybody obtains a premium tax credit, and they're going to cross-check your returns, and if you didn't have 95% accuracy, they're going to automatically trigger that penalty notice, and now the burden of proof, again, is going to be put on the employer. So as we get into 2016, yep, by the end of this summer or the end of the year, we will certainly see an increase in penalty notices.
Yeah, so I want to thank everybody who's sending in. Oh, go ahead, Joanna.
I just wanted to add to what Greg was saying. One of the big differences for the 2016 year that wasn't in place in 2015 is that ACV system that the IRS had in place. They're basically fine-tuning it, and they're looking for what sort of more high-target employers. In other words, before it was sort of randomly done. But now they're looking for sort of higher penalty targets, so that those, basically larger penalties are sort of what they're going after now. It seems to be that 2016 is focusing on that more. That doesn't mean that if you don't have a high penalty that you're scot-free, but they're really putting emphasis on making sure that the high-value penalty letters are get sent out.
And thank you for everybody who's sending in their questions. We are going to answer questions at the end of the presentation. Let me know if you can hear me better. Thank you for the people who voted that I was not as loud as Greg. So moving on, Greg, talk a little bit about the employer mandate and how people can confirm that they are part of the required ACA reporting as an employer.
Sure. The employer mandate affects employers that have 50 full-time or full-time equivalent employees. They would be subject to the employer mandate. They must properly identify their ACA full-time and make offers of coverage, and they need to do that to 95% accuracy. Then at the end of the year, they need to prepare the forms 1094 and 1095 and file those with the Internal Revenue Service, as well as furnish the forms, the 1095 disclosures to the employees. That all needs to take place at the end of the year, but again, what you file is a month-by-month compliance. So we find a lot of employers are treating this as a year-end activity when this should be done from a monthly accounting and reconciliation standpoint.
So when an ESRP is triggered, what are the potential penalties that employers face?
There are two main penalties associated with the employer mandate: the 4980HA as well as the 4980HB. The A penalty is the hammer penalty. Essentially, they're going to look at your ACA full-time count for that month, and they're going to give you 30 freebies. So, for example, if you have 130 full-time employees in July, you minus that by 30 freebies, so you're left with 100 full-time, and then you're penalized roughly $193.33 times your full-time count. So if it's 100 ACA full-time, then that's roughly $19,330 per month, or $230,096 and change per year. So they're substantial. That's for if you fail to offer coverage. Separately, if you choose to offer insurance, the offer needs to meet two components: minimum value, and there's an affordability component that needs to be calculated. If you fail those two components and the employee goes to exchange, obtains a premium tax credit, that will trigger the B penalty. That is a lesser penalty. It's on a per occurrence basis, roughly $290 for every employee that is obtaining a premium tax credit for every month they get that premium tax credit, assuming the offer of minimum value and affordability was not met. And those are part of all of the discrepancies we are seeing within these filings, is that employers are just not reviewing any of the returns that are getting filed by the various systems they have in place. And then the IRS reconciles and sends out penalty letters, and it's just causing a lot of confusion and a lot of exposure for employers.
Well, in addition to these penalties, there also are penalties for late filing, and you want to kind of review those, Greg?
That's correct. I think it's very important to understand the difference. There's a lot of confusion in the market between what the IRS announced as good faith effort for the 2015, 2016, and 2017 tax years. So the good faith effort applies towards these Internal Revenue Code Section 6721 and 6722 penalties that you see on the screen there. Those are essentially the requirement that you must accurately prepare the 1094, 1095 forms. You must furnish the 1095s to the employees within a proper deadline, and then you must file those forms with the IRS. The IRS understands that this is the first time all businesses in the United States are having to prepare these tax returns. So they said, if you file on time and you correct the inaccuracies, you qualify for good faith effort, and therefore there will not be any penalties assessed on the inaccuracy or timely filed returns. Those are very different and separate from the 4980H penalties. The 4980H penalties have always been the law of the land since 2015. In fact, the IRS communicated a memo that states there is no waiver of penalties in the statute of the law. And so I think employers are shocked to get this penalty letter when they were under the assumption that maybe there was good faith effort, but I think they confused the difference between having to comply with the A and B penalties and offer of insurance versus the good faith effort for preparing and filing tax returns.
And the other thing to keep in mind is that if you haven't filed for some reason, you should file right away, right? I mean, if you for some reason didn't file in a certain year, you shouldn't just let it run because the meter's ticking, so to speak.
Absolutely. If you don't file a tax return, you never told the statute of limitations. Joanna, did you want to comment on that as well?
Yeah, and also if you don't file, you're not eligible for potential good faith relief. And good faith relief doesn't mean you didn't do it, you shouldn't be penalized. Good faith relief is based on a showing that you as the employer have to make that you tried to comply but you were unsuccessful, and you have to establish that you made the effort to try to file correctly but there were some errors or whatever, but that it was reasonable for you to have not done it accurately. Essentially, you have the burden to show that you tried in good faith. And as part of that, if you can't show good faith, there may be, you may be in the realm of intentional disregard, and that basically jacks up your penalties significantly. And there's no cap on it. There's certain caps on the late filing or inaccurate filings. But it may not be much consolation, because if you've got a $260 per return penalty and you've got 100 returns at issue for the 100 employees, I mean, we're talking about, my math isn't so good, but I think that's $26,000 for 100 employees per return. But if you, if you don't file it on time and they can, you can't show good faith, you may be in intentional disregard. So for the same 100 employee returns, you're talking about $52,000, and there's no cap. So that's a big deal. I mean, the caps, as I said, may not be super consolations because, you know, the caps are like, you know, $1 million maximum for a small employer and over $3 million maximum for a large employer. So, you know, these are penalties separate from the substantive requirement to offer coverage. This is like, did you file it and did you file it correctly? This is very important to understand. There are two different sets of penalties. You could be exposed to both. And the penalties that are associated with the late filing, you know, only get reduced if you can show that you made good faith effort to comply.
And Joanna, we had just a point of clarification. We've got at least one question on this. Can you explain what the shorthand is for MEC and for PTC?
What the what?
For MEC.
Minimal essential coverage.
Also for PTC.
Oh, okay. Well, it's kind of funny because minimum essential coverage is actually not defined in the Internal Revenue Code or the regulations, but rather it is referred to by example. So one of the things that minimum essential coverage is employer health plan, you know, a medical plan. An employer, a plan sponsored by an employer would be considered minimum essential coverage, as would coverage under the individual market through one of the exchanges. This is where people would get premium tax credits, as would Medicaid or Medicare. And there's certain coverage under TRICARE and veterans care. But, you know, for most employers, what they'll see is the, you know, employer-sponsored plan or the coverage through the exchange. Both of those would qualify as minimum essential coverage. And for an employer, you can think of it as just health coverage, sort of generically.
And Greg, do you want to explain what PTC stands for?
Sure. Premium tax credit.
Tax credit. Oh, you can do that, Greg.
Oh, sorry. Yeah, so essentially premium tax credits are the subsidies that a low-income employee would obtain on an exchange. So if the household and income of an employee falls within 400% of the federal poverty level, then the IRS is going to give them a premium tax credit to help subsidize their premium because that's the affordable part of Affordable Care Act. But that's what's getting reconciled. So it's the employee obtaining a premium tax credit that triggers the IRS to use their technology system to cross-check for a 1095 that you filed, then look at your returns to see if you actually made an offer of insurance that met minimum value and affordability, or did the employee wrongfully obtain the premium tax credit. So they're trying to figure out, should they claw that back from employees, should we penalize employers, or does that premium tax credit get funded by tax dollars?
So with that, Greg, just finally, why is it, as we go through this kind of prelim to the common errors that Joanna's going to review, why is it a good time to re-examine your compliance process? People have been at it now for a few years. Why should they go back and look to see how they're doing?
Yes, certainly. I think understanding that it's the premium tax credit that's going to trigger the IRS to take a look. If you understand the underlying data, there's 272 million people in the United States that are under 65, and Kaiser Family Foundation reported that in 2017, 8.7 million people obtained a premium tax credit. So that's roughly 3.2% of the workforce under 65 got a premium tax credit. So as an employer, I'm looking at my company. If I have a large portion of hourly workforces that are falling within 400% of the federal poverty level, then I have a good odds that 3.5% or greater went to the exchange and got a premium tax credit. It's going to cause the IRS to look at what you filed. So because the IRS is just getting these systems in place, they're fine-tuning them, they're working on the 2015 tax year, it's best practices for employers to now look at what did they file in 15? What did they file in 16, 17? If they filed on time, take advantage of that good faith effort, correct those returns before the IRS cross-checks that and sends you a penalty letter, and correct that now. Separately, we are in 2018, and this is month-by-month compliance, so it's a good time to reevaluate how you're managing, what systems in place you're using, and who's essentially reconciling on a month-by-month basis to ensure accuracy, so that at the end of the year, when you prepare the returns, you're not filing returns that are causing red flags and having the IRS send you penalty letters and putting the burden of proof on you to clean up all the inaccuracies. It's very important to do that now.
So that leads us to our first. Oh, go ahead, Joanna.
I just wanted to add regarding premium tax credits. I think there's a common misperception that you really have to make a very low income to get a premium tax credit, and that's not at all correct. It's based on the federal poverty line, but for example, for an individual with a household of 4, what would be potentially eligible for a premium tax credit would be about $100,000 a year, which is pretty sizable income. And so, it isn't people who fall on the federal poverty line. It's it goes up to 400% of the federal poverty line. And so, individuals making a decent sized salary could still be eligible for the premium tax credit. And as Greg had earlier, mentioned, that it's all about the premium tax credit. That's what triggers these penalties. And so, what we're seeing is employers are having a substantial number of employees getting premium tax credits that were surprising.
Yeah. One thing to note, it doesn't matter even if you did make the offer. What's happening is the employee is declining them, and they're still going to the exchange to obtain the premium tax credit because it may be a cheaper way for them to get insurance, but they don't realize that ideally at the end of the year, if you prepare an accurate 1095, you're reporting to the IRS that you actually complied with the law, and therefore when the IRS reconciles that PTC with your 1095, then they'll claw back the premium tax credits that the employee wrongfully obtained. So the accuracy of who you prepare 1094s, 1095s on, and the information around the offer of coverage, minimum value, and affordability needs to be very accurate.
So with that, before we jump into the 6 errors we're going to review, let's take our first poll question. And it's the question is, do you review all the 1095-C forms before they get filed with the IRS each year? You can see the answers there, yes, no, but we spot check some forms. No, we leave that to our ACA vendor. No, I don't know. So we'll take a moment to get your answers in here. And so far, it looks like most of you are checking your 1095-C forms, which is great, more than half of you. And then there's some who do some spot checking, about 17% or so. And some are leaving it to the ACA vendor. And some don't know. But most people are checking, which is great, Greg, and that's the best practice we talk about too, right?
That is correct. Yeah, assuming they're validating the actual codes with the timing of the offer and the employee's calculations of ACA full time or not. We see a lot of forms are going out to employees that should not have received a form.
So something to consider if you're not already doing that, to check your 1095-Cs regularly. So with that, let's move on to the common errors that can seriously impact your ACA compliance process. And we're going to let Joanna walk through these with you. Joanna?
Okay. So, here we just have basically the 6 items, and I'm going to go into each one in detail. But these are the six common ones. One is failure to make continuous offers of minimum essential coverage and or minimum value affordable coverage. Not providing accurate and current census information about the employees. Failing to identify the full-time designated employees. Incorrectly applying one of the 2 IRS-approved measurement methods for identifying someone as full-time, failing to document the offers that are being made to the employees to comply with the ACA, and failing to track the enrollees on the medical plans that they're enrolled on. If we go
and Joanna, how are you going to run through these? Yeah.
Yeah, I'll just go through each one, but basically with respect to each error, I'm going to first talk about why the errors are important, how they impact the filing itself, and what you can do to address or avoid these errors.
So Joanna, let's start with failure to make continuous offers of coverage. The next slide. Why is this important?
Okay, let me talk about this really in terms of, I can talk about it with respect to minimum essential coverage, or MEC. Now, if you're an applicable large employer, you are required to extend offers of minimum essential coverage to your full-time workforce and their dependents each month of the reporting year. So this is where that continuous offer of coverage is important. Just because you offered it for 1 month or, something less than the full year, you're not going to be able to avoid the penalties for those months where you didn't offer it. So it's important that you cover every month of the reporting year. And if you don't do that, you can be subject to 4980 penalties, which can add up significantly, as you saw on earlier slides, both with respect to the A penalty and B penalty, if it's also not affordable or meets minimum value.
So the critical thing is, every time you get new employees, you have to be offering them coverage. You can't wait at the end of a year and say, oh, now I'll offer people who joined us earlier in the year coverage. It's going to be continuous.
That's right. That's right.
So
okay.
how does this impact the IRS filing?
Well, one, this information you've actually got to report on the 1094 and 1095C forms. With respect to the 1095C form, that's the one that goes on a per individual basis. It goes on line 14, where you have to identify coding with respect to what kind of offer, if you made an offer, and who the offer was made to. That information is reflected on line 14. In the event of an IRS audit, you're going to have to support exactly what coding what the coding you identified as the type of offer you made and to whom you made it to. And what's important is, an offer of coverage covering a month will preclude that full-time employee to whom you made the offer of coverage from receiving a premium tax credit for that month. Again, that's got to be both minimum value, affordable, and an employer health plan. So if the employer health plan meets minimum value and is affordable for that employee, that would preclude that employee from getting a premium tax credit. And it is this premium tax credit that triggers the penalty assessments under 4980H.
So what do you do to make sure you don't commit that error?
Well, the key thing is, you need to offer minimum essential coverage for at least 95% of all full-time employees and their dependents. As Greg had alluded to earlier, that coverage of 95% is pass-fail. It doesn't matter if you hit 94%. If you did not hit 95% or more, you will be subject to this 4980A penalty. So it's really important that you hit it. And 95% is essentially everybody. And that was what the IRS intended. That 5% was really kind of an oopsie for employers, somebody who slipped through the cracks. So, the approach should be to cover everybody. And that's what that 95% standard is. It's 95% or better, or you didn't comply. 94% is not good enough. That will avoid your A penalty. As part of this continuous coverage with respect to avoiding the B penalty, you want to have at least one healthcare plan with respect to self-only coverage. That means just coverage for the employee. It has to meet minimum value and is affordable to that employee. There's a big distinction with respect to dependent coverage and employee coverage. While you have to offer MEC to the dependent, the coverage does not need to be affordable for the dependent. The only person that it needs to be affordable for is the full-time employee. So, like what we see a lot of is healthcare plans. There's an employee premium that has to be paid for self-only coverage and a different premium paid for dependent coverage. And the ACA is monitoring the employee coverage, not the cost of the dependent coverage. So for, Mr. Smith, the employee, as long as his coverage is affordable, it doesn't matter how expensive it is for the rest of his family. I'm not making any comment on whether that's cool or not, but that's just the way the ACA is drafted. And then, you need to also make sure that the plan covers the entire reporting year. You'll see a lot of non-calendar year plans. So, it's part of the reporting, you're going to be reporting on the two portions of the two non-calendar year plans to cover the reporting year at issue.
So, Joanna, let's move on to the next error to avoid, not providing accurate and current census information about your employees. What's that all about?
Yeah, well, census information is a little bit of a broad term, but that would include from the name, social security number, the work location that the employee works at, his or her job title, his pay rate, whether or not he or she is full-time designated, and so on. It's just general information about the employee. And I want to focus, for purposes of this accuracy discussion, I want to focus on the name and social security number. Those things are reported on the 1095-C schedule. So with that respect, it's important to make sure that that's accurate.
And
next slide.
Again, well, how does it affect accuracy of the IRS filing?
Well, this continues why it's important. As we've been, kind of we're saying repeatedly, the IRS tracks the employees who obtain the PTCs, and they'll compare it to the 1095-C schedule to determine if and how much should be assessed against the employer. So if you have an inaccurate name, you have an inaccurate social security number, what we have seen before are what's called TIN errors, which are basically, the taxpayer identification number errors. And that can result in rejection and filings. It can also result in, the IRS unable to reconcile the employee who got a PTC with the 1095-C schedule, and in which case what the IRS may end up just doing is basically assuming that that's just an additional employee that you just didn't report on and you should have, and then sort of putting the burden on the employer to say, no, that person's already covered under this correct social security number or whatever. But also, in addition, we were talking about the 6721 and 6722 filing and furnishing penalties. TIN errors can result in reporting penalties because that's considered an error. There's a certain procedure and how the employer is required to get those in accurate status, and failures to do so can subject you to those 6721 and 22 penalties. So that's why that's important. I haven't gotten into it too much here, but I mentioned earlier there's also additional information with regard to the census, which is like the position, pay rate, and so on. And those things clearly need to be updated. Okay.
So what do you do about this to avoid the error?
Well, you want to periodically check in with your workforce to make sure you have the most up-to-date and complete information. As I was talking about earlier about the employee position, title, rate of pay, whether full-time or part-time, whether seasonal, in addition to the social security number and name. People get married, they change their name. I'm not aware of social security number changes, but sometimes when somebody's filling out their information, it's done by pen and the social security number is wrong. You want to just confirm that the number that you have on file is correct with regard to the social security number. Make sure their addresses are correct, like the addresses are going to go on the 1095-C forms. And that's where it gets furnished. So all of the information that about the general information that you have on the employee, most of those components are used in some manner to complete the 1095-C. So it's important to make sure it's right. And because people's rate of pay, position, title, full-time designation, addresses, what have you, those things can change. You want to make sure that you periodically check in and make sure that they stay accurate and are updated.
And a critical thing for this is making sure that each database you use, like your benefits admin and your payroll and others, all match up with the same information, because that can be a problem.
Yeah, that is really key. Like what we see is your time and attendance database may not be linked to the payroll database or the benefits database. They're like in 3 different data silos. And when you make a change in, say, the person's last name because the person, say, got married, you need to make sure that it is, matched up with regard to the other databases so that they aren't treated as 2 different individuals. So that is a really, really important thing to make sure you're doing as part of the check-in, is to make sure that all your databases that have the different aspects of content for ACA compliance are aligned and all updated together.
So Joanna, moving on to the next error, failure to identify all full-time designated employees. This can get tricky, right?
Yes, yes, and and it's one of those things that in part it starts off with the census. Like when a person gets hired, with this reasonable expectation that he or she is going to be working so-called full-time hours of service, you want to have that designation. And I'll get into the details of that in a minute. But, I want to make sure that the audience understands one of the basic elements of the ACA is whether someone is full-time under the ACA is based on 30 hours of service per week or 130 hours of service per month. Most people think of full-time as 40 hours. Not so under the ACA, so it's very important.
So why is this an important area to be worried about?
Well, because whether the employee classification, full-time designated or otherwise, that can dictate eligibility and the healthcare premium contribution level as defined by the employer. And while this is really outside of the scope of this particular presentation, health plans will have these sort of ERISA-related documents like summary plan description, summary plan documents. Those things will identify the eligibility and often the contribution levels as well. But so assuming that that is in line, you need to make sure that the employee classification is right, because if you've already defined who gets coverage, who doesn't, and what the contributions are, by whether someone's full-time or not, but somebody's improperly classified, you can see that creating a problem. The ACA, at the outset of full-time designated, full-time employees, you have to receive an offer of coverage no later than 90 days from the date of hire. So, and failure to do that is going to create exposure to these A penalties. There's certain, like, what I'll call, it's not quite a freebie, but basically the first 90 days is part of what's called limited non-assessment period, where an individual will not be subject to a penalty provided they get coverage on the 91st day or sooner. So failure to make the offer within the 90 days creates exposure for A penalties for that 90 days. And all of this has to be reported in the 1095-C schedule. So it's important that you get it right.
Well, that's right, because that impacts your IRS file.
That's right. So, if you've misidentified who are full-time and who are not, you're going to obviously have inaccurate 1095-C schedules. If you've identified people who really aren't full-time as full-time, you create the problem of having an overcount of full-time employees. And if you didn't hit that 95% offer of coverage, you're creating yourself significant exposure to the A penalty, number one. If you undercount it, then you are potentially, while you may have some cover for the A penalty based on your 1094-C schedule, the bottom line is that person was inaccurately identified as not full-time when they were full-time. They were eligible, and that in and of itself may end up creating an undercount of full-time in your 1094-C when it should have been a higher number. And, if you get a 226J letter, it is up to you to prove that whatever was reported was wrong, and that the IRS is wrong in assessing the penalty. And so you're going to have to prove this person wasn't full-time when, that person got a premium tax credit. And so, you're going to have to prove that. So if you fail to correctly identify them in the first place, that's a problem.
So what do you do to avoid this error?
Well, right, your census database with respect to the full-time designated, it's going to be very important that you identify whether someone has this reasonable expectation of working 30 hours or as like full-time, like for example, like your typical full-time designated person would be a salaried individual. You want to make sure they're designated as such, and you're making sure that you are applying the 30 hours per week or 130 hours per month standard as who's full-time or who's not. Making sure that you have your waiting period policy for these, typical salaried employees complies with this 90-day limit. There's a slightly different rule if you have, if you're using the look-back measurement period, which I'm going to get into later. But as a sort of general rule, you've got to hit this 90-day period limit.
So that's going to move us to our next poll question here as a prelim to our next error. Which IRS-approved measurement method works best for variable hour workforces? This is just to test your knowledge. You see the answers there. Interesting to see what you believe. There's a look-back measurement method, the monthly measurement method, the IRS measurement method, my own combination of the two, and I don't know. So we're getting some responses here. So clearly, most people believe that the best way to measure variable hour workforces is to use the look-back measurement method. 19% so far are saying the monthly measurement method. Joanna, what is the right answer?
Well, generally speaking, for a variable hour workforce, you want to do the look-back. And the whole sort of, a variable hour workforce is really just employees where you really don't have any predictability on their hours, hitting the sort of full-time threshold under the ACA. So, like, for example, you have a retail operation where, they have shifts, and each week the shifts change. Everyone's supposed to be part-time, but somebody gets sick, somebody quits at the last minute, not sort of prepared for, high turnover industries. There's a lot of variability in their hours, not, sometimes being full-time, sometimes not, or not being able to ascertain that they're going to be full-time. Now, keeping in mind, if you've decided that you're going to make an offer of coverage to everyone, whether they're part-time or full-time, the status becomes less critical to make sure you get right. But because healthcare costs are typically the second biggest cost right after wages, this becomes a big issue, and that's why this look-back measurement method is so important for these variable hour employees.
So that leads us to our next error to avoid incorrectly applying one of the two IRS-approved measurement methods. So why don't you continue on with that distinction?
Sure.
We know we're talking about the look-back measurement method and the monthly measurement method. Let's talk first about the monthly measurement method. What's that really designed for?
Okay, so there's these two methods, and as far as those are the only two that the IRS has sanctioned. The monthly measurement method is very straightforward, and it's generally designed for, sort of salaried, full-time employee type workforce. So the way that the hours are calculated are basically at the end of the month. So your employee, Susie Smith, works 150 hours in January. Susie Smith is a full-time employee for that month. Susie Smith works 120 hours in February. Susie Smith is part-time for that month. You can see that as a matter of, as an HR person who may be the one in charge of making sure employees get covered, that could be a real pain to if that person changes every month in different status. It's like most health coverage, it's either coverage for the year or it's not. You don't get to cherry pick every other month that the person gets coverage. And most importantly, you're looking at the hours at the end of the month to say, okay, that person is full-time or not full-time for that month. Well, that month is already passed. So if that person is determined to be full-time for that month that person should have gotten coverage, which you wouldn't know until the end of the month. So this is really for if you could just kind of know, you can predetermine that the person is going to be full-time every month. And that's typically like salaried employees. That's sort of an obvious example of where the monthly measurement just really makes sense.
So let's talk a little bit about the look-back measurement method, Joanna.
Given the time, I'm going to have to probably fly through some of these. Look-back measurement method is complicated, and I'm just going to go over just very high level what it entails. There's a measurement period. That is the period that you are looking at to establish the full-time or non-full-time status. There's an administrative period, which is typically, it's an optional period. You don't have to have it. Can't be more than 90 days as compared to 3 months. It must be not more than 90 days. This is typically when you have your kind of open enrollment period. That's typically how you want to lay the administrative period in terms of time frames. And then you have the stability period. That stability period, which immediately follows the measurement period or the administrative period, if there is any, where that employee status that you determine during the measurement period. Like if you determine that person was full-time during the measurement period, that person's stability period, that person has that status. I know that was really convoluted. So Joe Jones was determined to be full-time during the measurement period. During the stability period, regardless of what hours Joe Jones actually worked, that Joe Jones is going to be full-time for that stability period. What his actual hours are irrelevant. That's the way the look-back measurement works. It looks back and then applies them on a forward basis.
So why is it important to pick the right measurement application?
Okay. Well, basically, if you don't do it right, you're not going to be correctly identifying who's full-time and who's not, and that's the exposure to 4980H penalties. Additionally, as I had mentioned before, is when you have employees who you've incorrectly determined as full-time, but they're really not full-time, you're basically offering coverage to people you didn't need. That doesn't mean that that's bad, but what it does mean is it'll increase your cost. Maybe we should skip this slide.
Right, and then so what do you do? How do you figure? How do you figure it out?
So you figure out: are you a mainly full-time workforce, or are you mainly the sort of variable hour, seasonal, part-time workforce? If you're salaried, that's really sort of an obvious way to use the monthly measurements. If you're variable hour, we really highly recommend that you use the look-back measurement method. And the IRS also allows you to apply the monthly measurement for salaried and the look-back for variable hours. So two different methods for two different parts of your workforce. Now, you don't have to do it that way, but you can do it that way. And what you need to do is make sure you align your measurement method with the applicable plan year. So if you have a calendar year plan that starts January 1, 2018, ends December 31st, that's where your coverage period is for that enrollment year. You want that to map exactly with your stability period. If you have a non-calendar year plan, let's say it starts in June 1st, you probably want your stability period to start June 1st. Otherwise, it is just too complicated to try to administer. Next.
And why monitor payroll records? Why monitor payroll records? What's the importance of that?
Well, the payroll records, clearly that's designed to, determine full-time status. You want to check your payroll records, make sure they're accurate, because that look-back measurement method is entirely, crunching the numbers that's in the payroll records. So making sure that those are accurate is really important.
And why is it important to get this right for the IRS filing?
Well, it's all about the penalty. And given that we've got 11 minutes of our presentation, let me just kind of fly through the slides, and I'll let you know which slide, because I think we have a pile more to go, and we've only had about 3 to air.
That's fine. And we'll be answering everybody's questions, whether we do it now or later in writing. So anyway, not documenting your compliance with ACA requirements, why is that important?
Right. Now, again, it's, the employer has the burden to defend the audit. So if you get a letter 226J and it imposes a penalty, you are going to submit a signed statement saying this proposed penalty is wrong, and here's why. Our calculations show X, Y, Z. Here's the supporting documents for it. You're going to have that. And really important is, what Greg was talking about earlier, they're still sending out letter 226J for the 2015 reporting year. It is now more than 18 months later. So you think about that. I mean, your HR staff, people leave, new people come, and, I don't know what I was doing last year. I don't know what my records look like last year. But, if you have the records, if you have the documentation, that's going to be key to putting it all back together. And of course, just spot checking it so you don't find out later that there's this big giant gap. So, what's really, what we've seen is people aren't documenting it, and then trying to create a picture after the fact is really problematic in terms of, one, reporting for the 1095C schedule, and also if you get a letter 226J. So if you could go to the next slide.
So what do you do?
Okay, so we've talked about minimum essential coverage. We've talked about minimum value, affordability. There are some documentation of this already, or you should have. The summaries of benefits of coverage, insurance companies will prepare those. They're required to. And on there, they'll say whether or not it met minimum value, minimum essential coverage. So that's a nice way of just sort of swatting that and taking care of that. A lot of employers have, and they've created, or their insurance company, their insurance carrier or brokers created these enrollment guides that provide this kind of information. You could use that to substantiate to the IRS that you provided minimum essential coverage, minimum value, benefits rate sheets. You could use that to support that, well, it was affordable. This was the rate that such and such employee paid. This is X percentages of his salary. Therefore, it's affordable, et cetera. But, having all this documentation is key. So here's a sample of an SBC. And like literally, it's almost always on page 6. It shows you minimum essential coverage, minimum essential, minimum value. Now, if you want to make sure you've got sort of a complete one, there's a thing like a document called an acknowledgement of offer that you can prepare to make sure you track it for every employee. Now, that's hard to do, but if you have that, that's sort of a really gold level proof that you made an offer. This is particularly valuable for people who decline the offer. Obviously, if they enrolled, it's pretty easy to, your invoices or whatever would show that they enrolled. But what about the ones who they don't have an offer, well, they didn't accept the offer? You want to prove that. And so like an acknowledgement of offer is great to have that. And then with regard to the sort of full-time ongoing employees, you want to make sure that part of the open enrollment process, they're always notified every year. Here's a sample of a sample acknowledgement of offer form. You got the person's name, the coverage period, and that person declined and signed. That's going to be a really great response if you get a letter from the exchange saying this person said he didn't get an offer.
And so what do you do to make sure you don't fall into this trap?
Okay, so with regard to, having the documentation substantiating your compliance, put them all in one central location that's readily accessible. Again, as I mentioned, we're talking about, potentially, we're talking about 2015 reporting 226J letters coming out now, 3.5+ years later, having them all there, and periodically reviewing the documentation to identify gaps, obviously for 2015 reporting, 2016 reporting. You want to make sure that if there are any gaps, that you address them as soon as possible because memories fade. Here's a sample report that our company prepares for our clients, which really kind of gives a summary of the potential penalty exposure. So, for here, it shows you the number of employees, active employees, full-time, and then there's people sort of trending that direction. We talked about limited assessment periods, which is typically in that waiting period, and how you don't actually have to make an offer during that limited non-assessment period. It's chock full of information that helps you kind of manage your potential risk.
So we're at our final error here, Joanna. We'll run through this and answer a couple of questions. And again, we will be answering all the questions in writing. So if we don't get to your question on this webinar, we'll be following up with a written answer to the question for you. So last one, Joanna, not tracking the enrollees on your medical plans. Why do we care about this?
Well, even though it's really not part of the ACA, the IRS instructions have specifically required that an employer identify enrollment details on the 1095-C. So it's not a function of who was given an offer and who wasn't. It's who actually enrolled. Like, they want to know that as well. And that there's specific coding that's required to be completed on the 1095-C. So you need to have that.
So what do you do?
Well, one way you could do it is look through your medical invoices. That typically identifies all the individuals who are enrolled. And if they're all consolidated, like one medical invoice for all of the plans that you offer, that would be a comprehensive list. But if you have multiple plans with different invoicing, you're going to want to look through all of them. You want to make sure that the enrollees on the invoices are actually enrolled and actually employed. It was kind of surprising. We've come across employers where the employer is still paying for premiums for employees that have terminated their employment. So you want to, separate from just complying with the 1095-C form and identifying who's enrolled and who's not, you could actually save some money, and or make sure you're not spending money that you don't need to be spending, making sure that the people who are enrolled are actually employed. And you can talk to your broker or carrier about how invoices are laid out to make sure you have all the information you need.
And importance to the IRS filing of this information?
Yeah, so with regard to the the benefits information in terms of enrollment, you have, for example, here you have to identify code 2C for the type of offer in line 16, and that code 2C supersedes all other coding, so you absolutely need to know that. So that's why you got to fill it in.
So some final tips before we jump to questions for a couple of quick questions. Just final tips, Joanna?
Well, we're really, been repeatedly trying to make clear is, this is not an end of the year kind of deal. You really want to do monthly reviews, because if you do monthly reviews, you can mitigate potential penalties for subsequent months. So if you see that you're not hitting that 95% in February, you can fix it by March. And so that you've really kind of staved off any further penalties. Maybe you're going to get tagged for February, but at least you can avoid them for March. If you wait until the end of the year and you go, oh, oopsie, we only did 93% penalty, you can't fix that. You can't fix your offer of coverage after the fact. You can't go, hey, Joe Jones, we didn't give you an offer, 11 months ago. We're retroactively giving you the offer. It doesn't work that way. The other thing is, if you are determining employer premiums based on, for example, rate of pay, the rate of the person's pay, that is going to be a function. That's going to be a factor in whether it's affordable or not. And so if you've established what the premiums are based on affordability on people's rate of pay, you want to keep track of their pay. And it will also help you, you want to stay up to date on your penalty potential risk. So that sample report I showed you earlier, that really, it's to just stay compliant and avoid penalties in future months. And it really does need to be done on a monthly basis. And to the extent that you've submitted previous filings, do a spot check. You'd be surprised how many errors we've come across in prior filings filed by other vendors. Like, spot check it, and the sooner you find the error, the quicker you can fix it. And the later, it just, its memory's fade.
So I think we have time for at least one question, maybe another quick one, and then Sylvie has to do her sign off for HR.com. But so this is a very simple question, Joanna. Somebody says, per the 90-day limit, did you say they can start coverage day 91 as long as they were offered within 90 days from date of hire?
Well, let me frame it in a way that I know is accurate. You need a 90 days is the maximum waiting period that's allowed. So that means coverage has to start on the 91st date. That doesn't mean you then offer coverage on the 91st date to be effective at a later date. It needs to be effective on the 91st date. So you may end up, presumably you would operate. Okay. Well, let me just finish that. Presumably you would have made that offer of coverage before the 98th day so that they could accept and be enrolled, and it's effective on the 91st day.
So another one, if you have an employee that falls below the 30 hours worked a week on average due to FMLA leave, they have to be offered coverage for the next upcoming year.
If they are if they are not full-time, under what? The monthly measurement or the look-back measurement? So what I think that's actually that would require a sort of a complicated response, and we could prepare one in writing on that. I think that's probably too hard to answer on the phone simply.
Sure. Of course, that's the one question I would pick for you. Here's another one. Here's another final one. What if the employee is covered on their spouse's plan? Is the employer supposed to track where they get their insurance from?
If the employer should do that, because what that tells you is that person has coverage and would be less likely to get coverage. What you want to do is, if that employee has coverage on the spousal plan, you want to get that acknowledgement of offer, that you made the offer to that employee and that employee declined. And in fact, a sample acknowledgement form, one of the sort of reasons for declining the offers because they're on the employer sponsor plan. You want to track that. But the key is you want to track the offer. It doesn't matter for the ACA penalty whether or not the person accepts it. All you want to do is you want to track that the person got the offer, and with one slight little asterisk in that the IRS instructions also want to know who's enrolled.
So that, I think, is going to have to end our session, but Joanna and Greg are both accessible to you. You have contact information at the end of the presentation. You are getting the full presentation. And again, we'll be sending you answers to all the questions, even the ones that we just answered. And if you have additional questions, by all means, please send them to Joanna or Greg, and we'll make sure to get them to you as quickly as we can. We're more than happy to help anyone trying to figure out the complexities of ACA compliance. So Sylvie, should we turn it back to you?
Thank you very much to Greg Casabucci, Joanna Kim Brunetti, and Gary Davis, and of course to our sponsor, First Capital Consulting, for the very educational webcast today. There's a lot of information, and as Gary mentioned, there are a lot of questions still to be answered, so it would be great if we could get those answers to you via email. Just a few reminders to our attendees. If you'd like to view this webcast again, the archive recording and slides will be available for up to 7 days for our free members. And of course, if you have a recertification membership or HR Genius membership, you have unlimited access to those. All webcast credits are stored in your HR.com account under View My Credits. You will also receive an email from HR.com within 1 to 2 business days with your certification credit information. Your feedback is important to us. Please take a moment to fill out the exit survey that will appear on your screen once the webcast is ended. And this concludes our webcast. Enjoy the rest of your day.